I've never seen before in my career. And if demand or the systemic stress accelerates, what is the systemic stress? It's if one of these banks in London has a failure to deliver. And it's not just the silver market. These banks are connected to everything financial. But yeah, the truth of the matter is London has been exposed as far as I'm concerned. Independence on the Fed anymore, that gold would go to 5,000 like that. Well, what independence? The Fed has no independence. So gold is moving in that direction. You got Bank of America just saying $67 for silver is their target for next year. And I think that the recent pause is the calm before the next leg higher. That I do believe. And maybe this is it here today as we're up over $100 as we're talking. You let gold go to levels that no one can imagine, and I think you will see that.
The global financial system is exhibiting unmistakable signs of strain as gold and silver approach a potential breakout that could redefine market valuations. Physical supply at the LBMA, COMEX, and even Shanghai exchanges is tightening dramatically, while global demand, from industrial use to central bank accumulation, continues to surge. Silver, now officially recognized as a critical mineral by the U.S. government, has shifted from an industrial commodity to a strategic national asset. This reclassification, combined with restricted exports from China, has created a new global dynamic, policy-driven demand meeting a shrinking supply chain. These conditions are forming what many see as a perfect storm for precious metals, one that could trigger explosive price action once systemic stress surfaces within the banking system. Andy Schectman, a veteran precious metals analyst and CEO of Miles Franklin, emphasizes that this is not speculation, it's structural. With major institutions now advising up to 25% gold exposure, the shift from paper wealth to tangible assets is accelerating. As trust in fiat systems erodes, gold and silver are emerging not just as hedges, but as the ultimate stores of value. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The growing shortage of physical supply at the highest levels, the LBMA, the COMEX, and now even the Shanghai market, they're all showing stress, if you will, in supply, and the amount of, or the number of deliveries is off the chart. And coupled with, surging demand for things like industrial, investment, central banks, sovereign wealth, the same stuff we've been talking about forever, man. Silver is being pulled from every direction. That's just the bottom line. And not enough talk about it anywhere except on the alternative media channels, so it doesn't gain any traction. But where you will start to see some traction, in my mind, is the fact that the U.S. government just designated it as a critical mineral. And to me, this changes the narrative. Silver is no longer just a commodity. It's a matter of national security, national strategy. And when you talk about the kind of potential that silver has, remember that in terms of market cap, it's the tiniest little nothing market. And when capital begins to flow in, like the United States government and the sovereign wealth funds, it doesn't move gradually. It will erupt at some point. I do believe that. But the bottom line, Jesse, is you got tight supply, you got surging demand at the highest levels, coupled with systemic risk and the LBMA and what could happen if we see a delivery failure, coupled with official recognition. I would say silver isn't just poised to move, it's ready to explode. And yeah, it has been catching its breath, and anything that moved that fast, 40% in a couple of months, is overbought. That's the definition of overbought, and it needed to correct. It did, and here we are back above 50 again. So yeah, I say buckle up for what's coming next. The fact that the U.S. just named silver a critical mineral, along with China's tightening exports, there's no coincidence there. This is governments recognizing, I think, silver's strategic importance. Go back a year or two, Canada, many of the miners and players in the silver market in Canada tried to do the same thing, to have it reclassified a strategic metal, not an industrial metal. But this is an understanding, an awakening. It means a floor has been put under demand, number one. You have policy-driven buying now that will be coming in from the U.S. and from other countries like China, who will see that this is musical chairs, if you will. And at the same time, you have a global supply crunch. You got players getting squeezed, and you get China, who is, a big player in the silver market, limiting exports. Yeah, that's a big deal. Now, silver isn't just an industrial metal anymore, Jesse. It's obviously strategic, and it's monetary. It's essential. And I think now that governments are making that official, I think from the level, the highest levels, maybe governments just lit the fuse. So yeah, I think it's a big deal. It's a huge deal, bigger than just about anything I've seen in a long time in the silver market. And look at the U.S. I mean, I don't care what anyone says. It ain't about tariffs. I've been saying that for a year now. It is not about tariffs. It is not about arbitrage. Sure, there's a little bit of that truth, but it's being reshored. And, I've been screaming this. Look, all this silver coming into the country can't just be about tariffs. That was the ruse to get it all back here. Some of it's flowed back to ease the burden at the LBMA, but what it really is the smart money trading ahead of the news. Like, they knew that this was going to happen. They knew that it was going to be reclassified a critical mineral. So what do? They reshore it. They say it's tariffs so that London releases it and Switzerland sends it. Oh, by the way, it's reclassified. I mean, everything that at that level that they do, you look at all the massive gold accumulation in 2016, 17, 18, and 19, and then the Basel III reclassification of gold. These things that at the highest level, information is worth more than anything. And the people accumulating it, the central banks, the sovereign wealth funds, they're not just the most well-funded. More importantly, Jess, they're the most well-informed. And I think that's really what you would expect to see, the inside money moving first. And I think we're transitioning to that point where it's now out in the open, at least more so than it's ever been. And at that point, it's anonymity be damned. It's everyone rushed to secure what they can while they can. So yeah, I think you will see that. 2 billion a day if you add the COMEX and the Shanghai market, but in London, 700 or 800 billion ounces a day with a float of 150 million ounces. What could possibly go wrong? And so, yes, they are. And I mean, you can simply say the silver inventories are extremely thin, and the pressure is accelerating. It'll be much greater if China and potentially the U.S. curtail exports. Part of naming silver a strategic element is that the U.S. can now very easily, the president can restrict and curtail exports. And this sets the stage for a potentially explosive reaction if demand or the systemic stress accelerates. What is the systemic stress? It's if one of these banks in London has a failure to deliver. And it's not just the silver market. These banks are connected to everything financial. And so you would expect to see a contagion, a systemic reaction reverberating through all markets. But yeah, I mean, the truth of the matter is London has been exposed as far as I'm concerned. And they're hanging on by a thread. There's exponentially more demand than there is supply, and there's exponentially more contracts than there are bars. That is a powder keg waiting to happen. In my career, almost 36 years, I've never seen Wall Street or Main Street acquiesce to anything other than 5% of gold, of an asset, a portfolio rather, being in gold. And and it was acquiescing at best. Fine, put 5% of your money in gold. Now, recently, we've seen the chief investment officer of Morgan Stanley say, no, sell half your bonds and buy gold. Their new platform, according to him, is 60 stock, 20 bond, 20 gold. You got Michael Hartnett, the chief analyst for Bank of America, with this very, very, very expensive newsletter that goes directly to the institutional traders, like many thousands of dollars a year. He's saying, no, it's 25, 25, 25, 25, 25 gold, stock, bond, short-term treasuries, gold. You got Jeffrey Gundlach, the bond king, saying, no, 66, what did he say? Jeffrey Gundlach said, 25% in gold, Monday morning, 25% in gold is not overweight. And then the 6,600 part, that's Jeffries. They used to be a primary distributor for all the world's mints. And they said 6,600 is their next target, at least intermediary target for where they expect gold to go before it takes a little bit of a breather. You have massive institutional money, traders and analysts and chief investment officers speaking to the most sophisticated traders in North America saying 25% of your portfolio in gold is not too much. I mean, that's just insanity, if you ask me. Goldman Sachs said, if 5% of the money comes out of the bond market because they fear that there is no, independence on the Fed anymore, that gold would go to 5,000 like that. Well, when you have Stephen Mirren sitting in the Fed, who it was Trump's advisor and the architect of the Mar-a-Lago Accord, he fills the vacated spot. What independence? The Fed has no independence. So gold is moving in that direction. You got Bank of America just saying $67 for silver is their target for next year. So when we talk about record highs around 4,400 gold and then it falling off and everyone's saying it's over, I find it disingenuous at best when you have these analysts saying this. And here we are back up above $4,100, and that shows the strength and the underlying support. So gold's held up because of central bank accumulation. And to me, that's what we've been saying forever. We've seen physical demand rising and global monetary stress increasing, all of the stuff that we talk about. But what I believe we are seeing, kind of what we were just talking about, is a slow motion global run on physical gold. And the pullback from those highs wasn't a breakdown, it was a consolidation, catching its breath, not throwing in the towel. Pick your euphemism. But the bottom line is gold isn't just strong, it's structurally more attractive than many people realize. And I think that the recent pause is the calm before the next leg higher. That I do believe. And maybe this is it here today as we're up over $100 as we're talking.
The U.S. appears to be quietly preparing for a fundamental shift in its monetary policy, one that could redefine the global balance of power. Triffin's dilemma, long a burden on America's role as the world's reserve currency, has reached its breaking point. The dollar's dominance has hollowed out domestic manufacturing while subsidizing foreign consumption. Now, policies are emerging that suggest a controlled devaluation of the dollar, accompanied by a revaluation of gold. The coming strategy may involve pegging long-term treasury bonds to gold, artificially supporting bond demand while allowing gold's price to rise and rebalance debt ratios. Behind the scenes, digital finance and blockchain-based stablecoins could act as new channels of liquidity, synthetically backing the treasury market and funneling proceeds into gold and Bitcoin. This mechanism would lower borrowing costs, boost exports, and gradually unwind the dollar's reserve status. If implemented, it could trigger a global monetary reset, where gold once again anchors trade and sovereign stability. Let's get back to the interview.
Look at Triffin's dilemma, which says as the world reserve currency, you will always have a net deficit in global trade because your major export's going to be dollars. The world needs more dollars than we can provide through trade alone. And so countries over time have to sell their currency to buy ours, weakening theirs, strengthening ours against those currencies, that is. And so over time, manufacturing flows to where it can be produced the cheapest. Vice President Vance has come out on White House letterhead saying, no, we can't do this anymore. Triffin's dilemma, it has been a subsidy for the consumer. It's been a massive hindrance for the producer. It's a broken system. We have to move away from it. Even the knucklehead that was Jared Bernstein, a true knucklehead, if anyone remembers him trying to explain how treasuries were created. He was the White House lead economic advisor under the previous administration. He did write a report called Dethrone King Dollar, where he says the same thing. Being the reserve currency is now a hindrance rather than a benefit. Now, if you are trying to bring back manufacturing, you have to have a weaker dollar. How do you get a weaker dollar? You let gold go to levels that no one can imagine, and I think you will see that. Now, you could argue Bitcoin too, but take a look at USA Tether as an example. USA Tether, which is already Genius Act compliant, their CEO is a man named Bo Hines. Bo Hines was Trump's crypto czar until August. So the rules that Bo Hines was creating, he is now benefiting from. What is Tether doing? They have 12 billion in gold right now, more than they have in Bitcoin. About 8 billion they have in Bitcoin, according to their last numbers that just came out. They were just at the Beaver Creek Mining Summit as a company, Tether was, which is one of the biggest mining summits in the country. Again, talk about Chinese disintermediating the market. Now, Tether is. So let's just play this out. The Genius Act says that any time, and to your point, I think they're using the cryptosphere, if you will, to get to where they want to go. And I know that sounds kind of crazy. I mean, it's like, here's how it works. So anytime money moves, it'll be backed by a stablecoin. It will move instantly, like Venmo or Zelle across a blockchain network, instant settlement, if you will, and it will be backed by U.S. treasuries. Now, the interest on those treasuries is not transferable to the holder of the stablecoin. In other words, Tether gets to keep that interest. What are they doing with it? Well, they're buying more gold than they are Bitcoin, but they're buying Bitcoin too. Now, if you realize that Bo Hines is in this and kind of an advisor, what if they've worked out a deal with some of these stablecoin holders? Say, here's what you're going to do. Anytime a dollar moves across the globe, you're going to back it with U.S. Treasuries to lower the rates synthetically, not organically. You're going to do that. And then you're going to take the proceeds and you're going to buy Bitcoin to someday maybe pay down the debt. And you're going to buy gold, not to let gold go much higher just for the hell of it, but because rising gold devalues the dollar, right? And makes exports more attractive. Now, you mentioned backing U.S. Treasuries. I mean, we had Michelle McCory, who runs part of my YouTube channel, had Judy Shelton on again. I had her on 6 months ago, but she said the same thing to Michelle, that in no uncertain terms, she believes, according to what Trump told her, that we will peg the back end of the bond market to gold July 4th of next year, the 250th anniversary of the country. So let's put it all together. So if you have synthetic demand created through the stablecoin movements, by everything has to be backed by short-term U.S. Treasuries, and then that pushes rates down, gives demand to the Treasury synthetically to run the government, and the proceeds of those things go to gold, which raises it synthetically, and to Bitcoin. At the same time, you now peg it to the back end of the bond market, the 5, 10, 20, 30, and even 50-year Treasury. What does that do? Number one, it keeps rates low to stimulate the economy synthetically and gives synthetic demand for the U.S. Treasury. It takes all of that extra money and puts it towards gold and Bitcoin, devaluing the dollar, giving us the ability to slowly pay down our debt using Bitcoin. But now if you take gold and back it to the Treasury market on the back end, you have zero upfront borrowing costs. You bring back your manufacturing at zero upfront borrowing costs. Yes, you have to pay it in gold in 20 or 30 years. Okay, fine. But the upfront borrowing costs are pretty much mitigated to zero. Bringing back your manufacturing, reshoring it, making all the new facilities that you need to make at zero upfront borrowing, and selling your goods into a massively devalued dollar. In other words, what I believe they are doing, look at all the crumbs, they're giving up on the reserve status in order to support the bond market. And by doing so, they would actually have a fighting chance, perhaps, to grow our way out of a problem. So I do believe that you will see. Now, people talk about, will gold be revalued? Look, that's not conspiracy anymore. It is actually in the Genius Act and says in 2026, they will revalue gold. Now, they could market to market, or maybe they go much higher. James Rickards is saying 24,000. He gets there by dividing the money supply into gold. Not sure exactly how he gets that calculation. It was a while ago when I listened to what he was saying. But the point of it is, you put gold at that level, it benefits every central bank on the planet, but it massively devalues the dollar. That's the point. The dollar in relation to gold would fall tremendously. And that alone would give us the ability to start selling our product to the rest of the world at a devalued dollar, giving up on the reserve status in order to reshore manufacturing, in order to have the ability to grow our way out. We are at a point in time, Jesse, where 60% of this country has a literacy rate below a sixth grade level. 60% can't read past the sixth grade level and have no college education. AI is already kneecapping entry-level jobs, and they predict in 3 or 4 years, half of those entry-level jobs will be affected by AI. So if you don't make anything, and AI is changing the dynamics of the world, and your population is less educated than ever, yeah, you got some problems. So I do think if there is any nobility in what he is trying to do, if I'm right, it is to bring back manufacturing. And the only way to do that would be to revalue gold, to devalue the dollar, give up on the reserve status, as Triffin's dilemma cites. And besides, all these countries around the world, they want to trade in their own currencies. They want to determine their own fate. They want the strength or weakness of their currency to mean something. Settling imbalances in gold. And I think we're coming around full circle to gold always being the center of the monetary system. In the BRICS nations, it will be a vehicle to settle trade and currency imbalances. Here, I think it's going to back the treasury market. To retain demand for the treasury market at the same time, they are loosening their desire or relinquishing their desire to maintain world reserve status. So we'll see. That's my thesis, and I've been saying it for a long time, and I believe it. We'll see how it plays out, because if we don't, our next generation and the one after that is in massive trouble, because, you don't live in the AI sphere or on Wall Street. Where are you going to make the money? And I think that's something people need to think about for a moment. And I do think he's trying to bring back manufacturing. This would be the only way to do it.
The world is approaching a pivotal moment where currency confidence, debt sustainability, and economic identity are converging. What's unfolding is more than policy. It's the quiet reconstruction of the monetary order. As the dollar's dominance fades, gold is reclaiming its historic role as the foundation of value, quietly moving back into the center of global finance. This transition is no longer theoretical. It's being engineered through legislation, digital instruments, and a deliberate restructuring of trade and reserves. The outcome will be a system where tangible assets, not promises, define power. The nations and investors who recognize this shift early will shape the next era of finance. Holding what's real, what cannot be printed or defaulted on, will define wealth in the years ahead. Prepare, position, and protect before the revaluation begins. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.